I'm Jake Hoffman,
I'm Cole Higby.
I'm Brian Connolly.
and we are Team Short VIX. Today we're going to be giving an investment pitch on Starbucks Corporation. So a quick company overview. Starbucks was founded in Seattle, Washington in 1971, over 28,000 locations worldwide. The current stock price as of closing on September 14th was $54.75, market cap of over $73 billion, and IPO'd back in 1992. A SWOT analysis of the company. Some strengths. Customer loyalty is really big with Starbucks. Great brand equity. A few weaknesses. There's a reliance on high margins. The high cost of the coffee drink in comparison to some of its competitors. Also a lack of revenue source diversification, as 73% of retail sales revenue is from beverages in store. Some opportunities. Franchising, expanding the food menu, or increased presence in the packaged coffee market. So a big opportunity here is the franchising, as Starbucks owns 50% of their stores that are company owned. So if they were more open to franchising and explored that might be an opportunity for growth. Some threats: a low barrier to the coffee market entry, low cost competitors, an increased focus on coffee drinks at restaurants, and specialty coffee shops. This is an example of the specialty coffee shop threat. It's kind of what happened in the brewery industry, with microbreweries and things like that becoming more popular. It'd be compared to like Budweiser or something like that would be similar to Starbucks, where some of the market share might get taken with that changing demographic. So potential risks for someone like Starbucks would be intense market competition. This is market competition from other large brands like Dunkin', or also the specialty coffee shops. A big dependence for Starbucks on the Americas operating segment is a risk. I think over 57% of their stores are in the Americas, so anything that happens in the Americas that could be detrimental to Starbucks, that really affects their business. And also commodity price volatility. The way that Starbucks operates is they use a lot of price to be fixed contracts where they have everything in the contract fixed except the price, and the price can shift due to the price of coffee beans, and so then that price can be detrimental to future business.
So Jake talked a little bit about the Starbucks history, but I figured we'd give a quick overview of the competitors that we considered as well. So we looked at Starbucks Corporation, Dunkin' Brands, and finally J.M. Schmucker. It is important to note that J.M. Schmucker is a little bit different from Dunkin' and Starbucks in the fact that they focus on off-the-shelf sales, as well as have other brands such as their jellies that also are included into some of their sales figures. Digging a bit deeper into Starbucks' key financial ratios, Starbucks has a price-to-sale ratio of 3.43, which positions the stock in the middle ground between a value and growth investment. These PE ratios are higher than both Dunkin' and J.M. Schmuckers, which suggests that they still have considerable growth in Starbucks' future. This is backed up by the fact that Starbucks has been able to grow its revenue by over 7% over the past 12 months. Starbucks has also been consistent in keeping their margins right around 31% over the past 3+ years, which shows that their management has done a great job being able to balance and maintain the variability with those coffee beans and stuff like that, and some of their expenses. This also helps reduce variability when you try to forecast the growth in Starbucks' future as well.
So for the financial valuation, we use the dividend growth model, the free cash flow to firm, and free cash flow to equity models. For the dividend growth model, we use the multi-stage model. We felt this was appropriate since in the recent years their dividend had been growing at a rate of around 20% roughly, which is pretty high. So we gave 10% growth for their first 3 years forecasting, and a 3.5% growth terminal value. Their capital asset pricing model gave a 5.87% cost of equity. Their WACC was 5.7%. And for the free cash flow to firm and free cash flow to equity, we use a constant growth model with a growth rate of 2.5%. So the dividend model projection gave a price projection of $64.43 per share, which would imply that the current stock price is about 14% undervalued. The free cash flow to firm value per share was about $55.12, which is right exactly where their stock price is currently trading at. And the free cash flow to equity value per share gave a projection of $63.05, which is about a 13% undervaluation. So in conclusion, averaging out those three valuation models, we came to a projected stock price of $60.83, which implies a 10% undervaluation. So with our investment decision, we suggest going long Starbucks in our out of the three companies that we analyzed.